Okay, let's say you got the perfect idea and you've built the first clickable prototype, but you need to move from prototype to production and you need a team that's gonna build this out. The biggest question that everybody asks is, how do you fund it? Well, in this video, we're gonna compare 7 different funding paths. And because I love frameworks, we're even gonna use our own fund tests so that way you can decide which one is the best one for you. So this video is gonna help you to start thinking about how you're gonna fund this business and what the next dollar will prove. We live in a world now where it's becoming really easy to build a pretty decent looking prototype, but it's actually becoming a lot harder to find funding because everybody wants to know what makes your idea, your business, uniquely defensible and hard to replicate. There's a lot of different milestones that you're gonna need to meet, from idea to prototype, until you're in a position where you have product and message market fit, and then you're starting to look to scale. Each milestone requires money, but a different type of funding, a different amount of time, a different level of risk and potential, a different source of funding. You got to start by defining what it is that you're going to need next, what it's going to cost, how long it's going to take, what decisions that evidence will unlock, and what you are going to do to minimize the risks. So now that we have that background, let's start with the first obvious source of funding. The first path is bootstrapping. It's using either your money or maybe cash that you have from a business or cash flow that you're generating from another business or work or something. This is usually the cleanest source of control. There's no need to add additional equity, no investors making decisions on your behalf, no need to create any outsource or outside repayment obligation. You take on all the risk, but you also get all of the rewards. This path is best when the milestones are affordable and you can tolerate the loss. It's also best when learning matters more than speed. If you have a high net worth, existing cash flow, or the skills to build everything yourself, then this can be a great method. Now, it's not the best method if you can't afford to lose, especially things like retirement savings, emergency funds, or going into very high levels of debt. Now, just because you start here doesn't mean that this is the only method that'll be available to you. A lot of businesses, a lot of people, they start bootstrapping and then they start looking for one of the other methods of funding. So why don't we take a look at one of those other methods right now? So SaaS is a business model. It looks like something we call a J-curve. That means that you start off by burning a bunch of capital until you have a product and a message that fits the market. Then you gradually start earning that money back until the initial investment is repaid, and then you start looking for the economies of scale where you can get extremely high margins. Now, the second path tries to smooth out the characteristics of the typical SaaS model. So instead of selling software as a service, you flip it and you use software to sell your service. Basically, you manually complete the work and try to automate everything internally. Let me show you what this looks like. Let's say your app builds custom meal plans. You could manually create a meal plan and send it directly to the customer. Just send an email. This method is really powerful because it gives you revenue right from the start, direct customer contact, and detailed knowledge of the workflow. Now, the money that you're making with this method can be used to fund the application. And not just the money, but also the knowledge and the feedback that you're getting from the customers can be used as part of the design. This method really fits when the customer's outcome is something that you can safely deliver without having to use a platform. But the biggest issue is scaling labor. And when you start a service, it can also pull you towards doing custom work, and custom work is very difficult because it's usually not repeatable. This is an excellent method that can give you the cash flow that you need to fund your future development. Okay, so we've taken a look at 2 ways that you can fund the idea. Now we want to start taking a look at how you can leverage other people's capital. So this method is hard. And if you do it, it might be a good sign that you have a decent idea that's providing real value. The third method is pre-selling access. So you can do anything from direct pre-sales to reward crowdfunding. There's a whole bunch of different platforms that can allow you to do this. The money isn't free. You still have an obligation to deliver, communicate, support the buyer, and manage what happens if the product is late or doesn't work. Here I see a lot of selling lifetime access or significantly discounted annual subscriptions. The biggest risk here is your ability to deliver a product that meets their expectations, and for lifetime members, the ongoing costs. Now, the benefit is that you get people that you can actually call design partners with a vested interest in seeing the product do well without having to give up any equity. And of course, you're going to get the money that you need to fund the development. So stepping outside of crowdfunding, let's talk about the fourth path. This is what we're going to call relationship capital from friends and family. This is very common at the pre-seed and seed stages. The people you know may be more likely to invest in your idea. That's the biggest benefit. The investment might be a loan, convertible debt, or equity. But this path has one of the highest personal costs. If the company fails, you can lose more than money. Money, family, and friends can be the hardest things to deal with. Even if you explain the investment, it can still cause damage. The best thing that you can do is document everything. Have the proper risk disclosures, seek counsel as needed. Try to keep the personal pressure out of the decision, and use qualified legal and tax experts. Make sure you understand all the applicable securities laws. And if you know that they can't afford to lose the investment, don't take the money. Use one of the other funding methods. For example, you can use this next one. So the fifth path is non-dilutive funding. So these are going to be things like grants. This is great because you may not have to give up any equity. You may not have to make any loan payment. If you qualify, some grants might have no obligations. But generally, grants for startups are far less common. Some programs don't provide grants to start or expand a business, so you need to see if you qualify. So now let's talk about the most popular, the most widely talked about funding method. The sixth path is selling an ownership interest or a future right to ownership in your company. This is the space that angels, family offices, venture capitalists, and equity crowdfunding lives. Now, each of these works a little bit differently. Angels, for example, usually invest their own money. Family offices usually have pooled family money, usually more than one beneficiary. Venture funds invest pooled capital and have obligations to their investors. They're investing on behalf of other people. Now, I have a tech, finance, capital markets, and a risk background, so I could really talk for hours about deal structure and the process of how to structure a mutually agreeable deal. But maybe I'll save that for another video if I get enough comments about it. Here's something that's just very high level view. You have equity, which can be divided into different share types and classes, each with their own rights. You can give ownership without control, ownership with control, dilution, the list goes on. There's a whole bunch of different things that you can structure within your capital structure. You have to think about what you're trying to accomplish and what you're willing to give to get it. And this structure needs to fit the investor's risk appetite and risk profile. Let's talk about equity. Equity is the most expensive funding model because you are giving away a part of the company. But if capital is critical to the business's own survival, owning 10% of $1 billion company is much better than owning 100% of nothing. So when does giving equity fit? Equity fits when the company needs risk capital, when you don't really want to have any repayment terms, when the potential outcome is large enough for the investor. Depending on the funding round, investors might want to see 20, 50, maybe even more return on their capital. Now, the biggest benefit is your capital without monthly payments. Plus, you might have people with experience on the board that can provide guidance, help with recruiting, customer access, and even follow-up support. Investors have a vested interest in seeing you succeed, and sometimes, but depending on the agreement, that alone might be worth the cost. So what's the downside? Well, dilution, governance rights, information rights, legal expense, and the pressure towards an outcome that fits the investor's model. Investors think in terms of exits. They're looking for either a buyout, an IPO, or something that gets them back their money plus the returns. If you're just trying to build a business that you want to run and aren't really thinking about exits, then this is likely not the model that you want to choose. It's also possible that you can give away so much control that you might lose access to the company. And there are a bunch of famous cases where this has happened. So now I mentioned terms like pre-seed, seed, Series A. I'm just going to quickly go over what these stages are and what they mean to you. This isn't going to be exact, but it'll give you a good idea of the purpose of each of these stages. So let's start with pre-seed. Pre-seed often means that the team is still trying to prove out the problem. You're forming the company, you're developing an earlier prototype, and you're trying to get market insights. So if you need money to build the actual idea, you're likely at the pre-seed stage. At this point, this is the riskiest part of the funding cycle, and that's because it tends to have higher equity requirements and lower valuations because really, The investors are investing in you. You don't have anything to prove yet. You just have an idea. Now, with the seed round, this commonly supports product development and market research. You might have a few demos or design partners, but you're usually actively working on your product and message market fit. Seed, you might start seeing a little bit of cash flow in the business. Next is Series A. Series A often supports a company with the initial customer base and proof of concept. By now, you should know that there's demand for your product and that you're using the funding for more growth, more than I would say product development. Product development is still key, but you're starting to fund that growth. Now, when you get to Series B, this often supports scaling production. It's all about expanding the customer base. By this time, you probably have a strong, solid customer base that exists, and your sales motion should be all worked out by now, and you're just in that execution mode. You're trying to acquire customers at a price that makes sense for the business. So now, in practice, these aren't hard lines. Things can look different depending on the situation. The labels matters less than like where you are in the use of funds. So when you're going for funding, you need to start thinking like an investor. Instead of selling to a customer, you're actually selling the idea and the concept to an investor. It's completely different. Every serious investor has a thesis, whether it's written on a website or held internally. They have a general concept that they're trying to prove, essentially. They may focus on a sector, geography, stage, business model, check size, ownership level, or a particular type of technology or founder. They usually have a focus. Their fund also has a timeline. It may reserve capital for follow-on rounds. It may lead deals. It may only participate when another investor sets terms. So with all of this, there's a bunch of different reasons why you could get rejected, and rejection doesn't always mean that the idea is bad. It might just mean that the opportunity doesn't fit that investor's mandate, timing, portfolio, or required outcome. So finding the right investor is just as important as finding the right customers. You want to find somebody that can help to accelerate your business. The best way of doing this is by researching their existing portfolio. An adjacent company may show that the investor understands your customer and can make useful connections. A complementary product may create strategic alliances. You have to remember that the investors are evaluating more than the prototype. They're looking at the team, the market, the business model, the governance, and your ability to execute. There's so much to know in this space, from building out financial models that include dilution to deal structure. The key is to understand what you're willing to give, what meets the investor's thesis and risk appetite, and why you have the right ingredients to increase the probability that the venture will be successful. You also need to make sure that there is an exit plan and that the business is big enough to be investable. All right, so we've looked at self-funding and the various methods of leveraged capital. There's still another method that most people don't even realize exists. The seventh path is really a family of structures. I'll just call it alternative funding methods. This is where loans, venture debt, studios, and hybrid arrangements live. So traditional business loans work by leveraging the company's assets, existing cash flow, and personal guarantees. Here, you don't give up ownership. Instead, you simply repay the loan based on the agreed upon terms. Now, most SaaS startups won't fit here. Sometimes you can take out a personal loan secured by personal assets that you can use for your business, but typically you need cash flow and other evidence supporting the repayment. Venture debt is different. This is a loan for high growth companies already backed by venture capital. Often it's used between equity rounds to extend the runway. Sometimes this debt is convertible, meaning that there's an option to convert the debt into equity. Usually this is for a business that has a history of raising funds and is well past the seed rounds. So venture debt is generally not the answer if you're only at the idea stage. It can supplement venture backing rather than replacing it for the first few equity rounds. Now, a venture studio is different. The studio may act as a co-founder and capital and talent and product development, recruiting, and operation support. They can be valuable for a non-technical founder, but it still may require significant equity and share control. Here, you will still typically pay for the development, just at a reduced cost, because the venture studios will take equity as a partial payment. They may also structure a deal in a way that requires full repayment of their development credits once you receive other fundings. It might be called something like a deferred fee. If the repayment is triggered by future financing, that is still an obligation even if no cash changed hands today. An accelerator is usually defined as a program offering mentorship, networking, office space, and sometimes capital. Again, they may require equity in exchange for this. An equity for services agreement adds ownership to a vendor relationship, very similar to some of the other agreements that we discussed. Between this and Venture Studios is kind of where our firm lives. Don't compare these arrangements only by the dollar amount. Ask who owns the intellectual property, what happens if either party stops working, what triggers repayment, is there interest, are there warrants or equity rights, is the agreement exclusive, who controls the product decisions, what happens if the next financing never occurs. The cheapest looking capital can become the most expensive once equity, control, restrictions, and failure scenarios are included. And some of the most expensive capital can help you drive results faster and can effectively be a lot cheaper. All right, so now that you understand where you can get funding, let's go through the fund framework. Now, the first test is to name the measurable milestone. If you can't explain what changes after spending the money, the raise is just not ready. If the next proof is affordable, then maybe you need to bootstrap it. If you can deliver it manually, sell the service first. If the customer understands the scope and will commit, consider doing a paid pilot or a pre-sale. If the idea is investable, consider raising funds or going with a hybrid structure. Next, you want to understand the obligation. List all the requirements and the conditions and what you're willing to give to get the capital. That can be equity, control, repayment, interest, covenants, reporting, restricted use, delivery promises, exclusivity, or founder time. If any of those obligations could break the company before the next milestone, either narrow the scope or choose another funding source. Next, we need to find the needed outcome. Ask what result the capital provider needs. What is it going to take to hit the next milestone, get the next customer, build the next feature? A customer needs the promised outcome. A lender needs repayment. A grant program will need compliance and reporting. A venture investor needs the possibility of an outsized exit. If the company can become a healthy, profitable niche business, but not a venture scale company, that's not a failure. It just means that venture capital is the wrong tool. Finally, you need to test it. Do your stage, sector, geography, evidence, timeline, and capital needs match the providers? Are the product scope, roadmap, budget, demo, technical risks, and due diligence materials ready for scrutiny? If you're not, then just defer the raise, narrow the release, improve the evidence, or bring in the right product and technical support. This quick test should help you to narrow down which of the funding methods might work. It'll help you determine whether you're going to bootstrap, sell the service first, pre-sale, maybe even look for grants, approach some relationships that you have, try to get an equity investor, using debt, consider studios, or if you want to narrow the scope or just wait. Maybe it'll help you to even rethink the whole idea. For founders, funding readiness and product readiness, they're connected. Investors will ask what's built, what comes next, what the money pays for, what can fail, how the product scales, and whether the team can deliver. That's going to require more than a polished prototype. The great thing is that the fund framework can help. And if you need more help from building the production to preparing for the investor pitches, you can click the link in the description. If you found this video helpful, comment and share. I'd love to hear from you. And if you like this video, then you're definitely going to want to watch this next one right here.